Welcome back, students. This is our second lecture of chapter number 9, Responsibility Accounting, and this is where we stopped last time on slide number 17. And if you remember, we said that the important aspect is the performance of the manager in responsibility accounting. It's very important that we need to evaluate the performance of each manager, whether it's a cost center, it's a profit center, or investment center. Cost center, we can easily look at the cost control, whether the cost has been decreased. If a profit center, we can simply look at a profitability. But if there is an investment center, now what is investment center? Where manager is responsible for the cost as well as the revenue as well as investment as well. This is what we have seen before, the difference between these three centers in responsibility accounting. In responsibility accounting, we said before that it is part of performance measurement, where managers are responsible for revenue, costs, and profits. Now, in our example, which we are looking at it, right, which we looked at it, if I can go back and show you this example here, right, this is what we started before in the last lecture, right, for this Panther holding company, that they have 3 divisions, right. Now, using this information, what is the income of each division and how we are going to evaluate the performance of each of the manager for this one, for these divisions, right. We can look at the information given, right, that how we are going to evaluate investment opportunities of these centers, right. How we can evaluate the performance of these centers, right. We said before, as I said, right. Now, how can we evaluate a performance? We can evaluate a performance if it's a cost center. We can look at a cost control. Profit center. Investment center is for return on investment. How do we calculate return on investment? This is what we will see it now. How we can calculate return on investment, right? This is our next section where we look at it. How we can calculate the return on investment. Why we need to calculate return on investment for a manager? What are the reasons, right? Because return on investment, it's a ratio of income to the investment, right, used to generate the income, right. Now, managers, basically, they are motivated to get more assets so that they can increase the income, right? Or in other words, managers are motivated to increase amount of assets, right, because this is the amount of assets which is what they control, right. So if they have more assets, using those assets they can generate more income. As a result, their return on income can return on investment can increase, right. So how we can measure a return on investment of each manager? We can simply divide the operating income over its asset under control. So in our example, if we look at here that in our company, Panther Holding Company, I look at here, this is the following information were given for their second level investment centers, right, because we said before that their second level investment centers are, right, were given. We already discussed it before. Again, I'm going back to our slide number 6 here. It is same thing, right. So this is how these were their investment centers, right. How they are going to evaluate their performance. As we said, they can evaluate their performance using return on investment, right. That is the one criteria to see the performance of each division. How to calculate return on investment for each division, right. Operating income for each division is given, and this is the operating assets for each division, right. These are given. So From here we can calculate their return on investment for each one and see which division is making more return on their investment, how much asset they have under control, and out of those assets how much income they are generating, right? Because assets are the investment by the owners of the business, right? Remember, what are the assets? These are the resources owned by the business. If you just go to very basic concept in accounting, assets are the resources. So who give the resources or who purchase the assets? The owners purchase the asset. Why they purchase assets? Because owners expect a profit or income on those assets. Now, which division is giving more return on the investment made by the owners in terms of assets? We can calculate not only the absolute number here, that this is the highest one, or this one is, let's say this one is the highest one, but if you see it here, this is the highest one, but also this manager is controlling more of the resources, right? So is it, this is the one best performance, or this is the best performance, or this is the best performance? Maybe only for numbers we can say, oh, this furniture manufacturing division is giving a highest income, so he is the manager of this division is the best performer. But we need to consider the amount which was invested in those assets, 482,000, which is also highest. So now, in order to actually see which is a best manager, we should not rely on these numbers. Rather, we should calculate return on the investment. So how we calculate return on investment for each one? So this is how we calculate operating income divided by total assets under each of their control. So now if you look at lumber manufacturing, although it is their income is less than furniture, right? But their return is the highest because they use less assets to generate more income. As compared to this one, they compare, they use an income, the highest income from all of them, but they use the highest assets as well. But in terms of return, so it is the lowest one. So we can see from here that the manager of this one, the lumber company, the division, basically he is the one who can say that his division is basically outperformed the other two divisions. So he may convince, let's say if there is an additional investment by the management where they want to expand their business, let's say there is an additional funding available and they want to expand it. So they might give those funds to lumber manufacturing manager because he is generating most of the income, right? His return on income, return on investment is the highest. So he might get a new funding as compared to these, or there might be a competition between other divisions as well, where let's say home building manager, he say okay, he need to improve his income so that this number will be increased. As a result of this one, there will be an increased competition among all managers to improve their income. And of course, if they improve the income, it is going to have the benefit to the company or to the owners. So the company's income will increase. Yes, now after we calculate return on investment, now the next question, especially in responsibility accounting, is how we calculate this reporting assets. What is the value of the assets? Remember, in accounting, we record the asset at its cost, right? So how do we value these assets? The value is at cost, right? What do I mean? For in accounting, when we purchase an asset, we record the asset at its cost. Now, in a real life situation, imagine that different assets are purchased in a different time due to certain changes, right? So I'll explain this one with now measuring operating assets. As we know that book value of the asset is to calculate return on investment, right? And it will result in higher return on investment, right? Now, what is a book value of assets? We know what is a book value of assets. Book value of asset is cost of asset minus total depreciation, or we call it accumulated depreciation. That is what we use a book value. Now, how it's going to distort return on income, return on investment, right? How it will do, I'll explain it with an example on page number 410 on your book. I'll go there. This is what we have in our book. I'll show you. Yes, if you see here on page number 410, right, as I said, that how we are going to value the operating assets. Now in this example here, suppose that this rental company has two divisions. This is just an example: Northern Division and Southern Division. Each rent to customer a vending machine that originally cost 5,000. So what they are doing is they are renting some machines to customers, right? Each divisions, Northern Division purchase a machine for 5,000 and give a rent to customer. Similarly, the other one as well, both. Now, these vending machines have a 5-year useful life and no salvage value. Northern Division purchased the machine 5 years ago, and the Southern Divisions purchased the machine 3 years ago. And let's say today you want to calculate their return on investment. In order to calculate a return on investment, we need their assets book value, which is cost minus total depreciation, right? Now for this one, for Northern Division, they purchased the machine 1 year ago, right? And its useful life is 5 years. So 5,000 divided by 5. So our depreciation expense for 1 year is 1,000, right? So what is a depreciation for this? Because it is only a first year, 1,000. What is a depreciation for this machine? Because it was purchased 3 years ago, right? 3 years. So their depreciation is 3,000. So the book value of this asset is 4,000. Book value of this asset is 2,000. Now imagine that both division has the same income of 800, right? Both same. So when they divide it, this income by 4,000, this asset, and income of the other division divided by its book value. So here you can see that the Northern Division, here their income, return on income is low, and here the return on income is very high. So what do you think? If you just look at return on investment, it clearly shows us that Southern Division performed exceptionally well. His return on investment is double than this one, right? Now, but in reality, we know that the only difference between these two numbers, right, is that here they are using old assets and here they are using new assets, right? So if you just use this information to evaluate the performance of a manager, it might not be a good idea, right? Because you may demotivate the manager of the Northern Division. In reality, they have the same income, right? So basically, those who are responsible for responsibility accounting at the top, especially, they have to see what are how we calculate the assets, right? Now, how we can solve it, or in other words, maybe let's say this manager, he may not be willing to replace his assets, right? Let's say after some times, when his assets are going to be finished and the depreciation value finished, he might be, they say, okay, instead of 5 years, I can extend to 1 more years, right? These assets. Why? Because if he has an old asset, he will have a higher return on income, right? So he might not be using the new equipment, right? Because it will reduce his return on investment, and as a result, he might be continue with old items, and those with old assets, it might you receive a complaint from a customer dissatisfaction, right? So company should maybe in this case try to solve this problem. They say no, instead of dividing it by 4,000 we can divide it by 5,000, 800 by 5,000, 800 by 5,000, and then compare, right? So in that case anyhow it will be equal, right? So both manager are doing the same. This is just a one way to solve this issue, right? So it is not an easy, it might be in reality it's not easy to look at the operating assets. So that's why it's very important when you calculate return on investment, see how the operating assets are calculated and they are reported. Then you can make an adjustment depending on a situation. So that's why it is very important. So going back to our slides. Okay. Now, so this was the reason that using book value of operating assets will calculate and return on investment will be a higher return on investment. So that's why it's very important. You have to see if you are using book value of asset, or we may use another approach could be replacement cost. Instead of using historical cost or acquisition cost, we may say, okay, what if we replace the assets? We should use, instead of this one, we should use replacement cost. This is a one solution, but sometimes it is not easy, because calculating what would be the replacement cost of a particular asset is not easy. It would be difficult. So that's why in real life, selecting asset valuation based is a complex matter, but still even with its all the shortcomings, still companies are using this method because it is simple and it can compare the performance of the managers. Now we are going to further divide return on investment into two factors, right? This is how you can improve your return on investment, right? We can basically divide it into two portions, right? This is a famous DuPont equation in return on investment, we call it. Simply what you did is you divide by sales, and here also you divide and multiply by sales. Basically sales and sales will be cancelled, but what we have done now, basically we split this into two, so that you can see how you can improve return on income, right? If operating income over sales times sales over operating assets. This one is operating margin, we call it, and this is the asset turnover, right? How we use asset in terms of sales. So this one will basically help us to see, right, how we can improve the ratio. Okay, now this is basically how we can see equation, right? This is a margin, right? Now operating income, we know how we can improve the operating income. It is sales minus operating expenses is one of the item in operating income. If you have less operating expenses, right, you can improve the income without even increasing the sales, right? This is a one way to improve this number. I'll explain again. We know what is an operating income. If you go back and see our income statement, right, sales minus cost of goods sold minus operating expenses, you get operating income. So one way to improve the operating income is to decrease the operating expenses, right? So decreasing operating expenses will result in increasing the profitability. This is a one way to increase return on investment. The second portion here, this one, it is we call it turnover. Basically how we use assets in order to increase the sales, right? Now how you can maximize the profit this side. For example, you cannot do anything here if you are a manager. What you can do is, in this side is to increase the sales, to increase your turnover. This is another way to increase your return on investment. Either you can increase the sales, right? If you increase the sales, this number will increase, right? Or you cannot increase the sales, then you come to this option, right? Remember, you are a manager of a company and your target is to increase ROI. So how you can increase ROI? Either by decreasing operating expenses, or if you cannot do it, you might increase the sales, or vice versa. If you cannot increase the sales, you might do it this one, come to this side and decrease the operating expenses. This is how, if you are a manager, how you should use ROI to improve your performance. Now we'll explain more with the example of the company which we already looked at it. This for lumber manufacturing division, about this Panther Holding Company. Now let's say this is the given information. The lumber manufacturing division, it has following information. Remember that operating income is 60,000, sales and operating assets is 300,000. So these were the information given, right? And this is how we calculated before, right? 60,000 divided by 300,000, right? We'll get our return on income of 20%. This is how it was calculated before. We already calculated it, right? I'll show you. This is how we calculate it, right? This one 60 over 300,000, right? Now what is a detail? This was a 20%, right? We calculated operating income by assets. This is what we done. Now let's look at it in another way, the same information, right? So if we divide it into two equations like this one, right, operating income over sales, this one. Now how we calculate our return on income? This is the same thing, divided by sales times this is this one, right? Now here you can see what are the factors, how you can improve. If you are a manager of lumber manufacturing division, how you can improve these numbers, right? So this is what we can, so how you can improve it. So this is what we know, that we can by reducing the expenses, right? Operating expenses will increase this number, or by increasing the sales. This is a one way, right? So, or another way, maybe you can reduce your assets. This is also another way to reduce the assets. So these are ways to improve return on income, right? If you decrease this one, or if you increase the sales, or you can decrease the assets. These are the ways. There are three ways to improve your return of investment. Okay, so what are these three? Increasing the sales, reducing expenses, or reducing your operating assets. These are three ways in which we can improve return on investment. Now let's say we'll continue with the same example on next slide. The lumber manufacturing division was able to increase the sales to 660,000, which increased their operating income to 72,600, and there was no change in operating assets. So what they have done, the manager of this division, right, what he has done, he, let's say next year he increased the sales to 660,000, and as a result of this one, his income is increased. So let's see now, if we calculate the return on investment. So 72,600, our sales of 660,000, operating asset is same. So now return on investment is 24.2%. Before it was 20%, right? So their return on investment has been increased from 20% to 24% by what they done is they have increased the sales as well as they have increased their operating income. Okay. Okay, now this is how we can improve our return on investment. Now if we go to next topic, sometimes we have certain issues. Now see, there is a drawback about return on investment method. For example, as a division manager in lumber manufacturing, your compensation package, imagine you are a manager of this division, and your salary or your compensation package is salary plus a bonus based on your ROI, right? If you have higher your ROI, the bigger your bonus is, right? For example, you have 20,000 plus 2% of your ROI as an example, right? Anything more than 20% or whatever your ROI is, 2% of that one will be your bonus. So now you can see your bonus depends on your ROI. If your ROI is higher, you get more income. Now let's say company requires, in this case, that 20% on all new investment. That whenever you have a new investment, now there is a proposal, right? The company will accept all projects if they bring 20% ROI on that investment. Now let's say your division is producing an ROI of 30%. Okay. Now you have a new opportunity where you are going to invest in a new project, but as a result, your ROI will become 25%. Before it was 30%, but with the new investment, your ROI, because of your initial investment in asset, right, your ROI will come down to 25%. So as a division manager, would you invest in this project? What do you think? Now here, now see, there will be a conflict, right? As a division manager, you say no. What you say, no, I'm not going to invest because it will reduce my salary, right? But a president of the company say, no, you must invest it because it will increase the profitability of the company, right? So these are some of the drawbacks, right, of using ROI, right? As a division manager, you wouldn't invest in this project because it would lower your salary, your pay, right? So this was the reason, right? Maybe someone who give you an idea, you may say, no, we are not going to invest in this project because it will reduce my pay. So this is some of the disadvantages of ROI. So that's why when we use ROI in responsibility accounting, we must know also what are its disadvantages as well, the limitations, and we should use those things carefully. So now coming back to our slide number 17, this is what we started, right? Return on investment. We have done how to calculate and return on investment for investment center. Now another approach, either you can use this method which we just looked at it, or we may use residual income. This is another approach to evaluate the performance of a investment center manager. Now what is a residual income? You know the meaning of residual, or if you remember, sometimes we use the word residual value in terms of salvage value, right? What is residual value or salvage value of an asset? Means after its useful life, how much is left, right? Salvage value or residual value. This is the word, we get it from there. Now what is a residual income, right? We come back here and see how it is calculated. What is residual income, right? It is operating income minus an investment charge equal to residual income. This is how we calculate a residual income. Okay, now again, if you remember, this is what we looked at, a major drawback, that a manager is hesitant to accept an investment proposal which might increase the income for a company as a whole, but it will reduce his salary, right? So this type of decision, right, where a manager has to choose between his personal best interest and the best interest of the corporation, right? This scenario, right? This is what we call it sub-optimization, right? What is the concept, right? Again, when a manager has to choose to benefit himself at the expense of a corporation, this is what we call it sub-optimization. In order to avoid this sub-optimization, it is on page number 413, right? The manager, what he can do is he can rely on a new concept to evaluate a project, which is this one, residual income, right? This is the concept. That's how we use residual income, right? Now here, residual income is operating income minus investment charge. What is an investment charge? Right, basically operating income, how we calculate it is, now what is an investment charge? It is operating assets times what is our desired return on investment, right? So this is what is their return on investment is a cost of acquiring new investment capital. I'll explain this concept on next slide with some numbers, right? Let's go to our example, lumber manufacturing division. Here they currently earn 60,000 of operating income with 3,000 of operating assets under their control. So their return on investment is 18%, right? So this was their return on investment. We already calculated right here with this information. Okay. Sorry. Now, I'll explain again. Now the 60,000 is their operating income and 300,000 is operating asset. Now 18% is their desired ROI, not from this one calculated. The company accept any project which give them 18% a return. Any new project which give them a return on investment or a return on investment of 18% or more, they should accept it, right? But we have seen in our previous case, the same company information, that there is a new project, right, which will increase ROI from 30 to 25%, right? See, I'll go back just to explain what was a situation we are facing. Right, in this situation, as an example here, maybe we have a situation where a manager income, his ROI is 30%, but if he accept a new project as an example, right, his ROI will go down to 25%. As a result of this, manager salary will go down and he might not accept this project. So same scenario here, right here. In this new situation, right, that a minimum criteria by a company that they will accept a new project if it gives this one ROI, right? Now if you look at calculating a residual income for this project, how we will go and calculate, right? Now you can see here operating income is 60,000. What is the desired income? How we calculated this 54,000? This is what we call it our investment charge, right? This is what we call it desired return on investment operating asset. This is their investment charge. Now how we calculate it? So what is the investment charge? How we calculate an investment charge, right? Or we call it a desired income. This is what a company want, their desired income, their wishful income, you can say, from a new investment. So if you calculate it, desired income is this one. How we calculate? Operating asset is 300, 18%, so 54,000. So 60,000 minus 54,000 is, this is what we have, their residual income. So this is what is left with the manager, right? So basically, even if he's not investing, so any company, right, how much what do you mean by 18%? Now, they could have invested 18% on some other asset or some other investment asset, right? But they have given the fund to him, to this manager. So basically they will not evaluate 60,000. So what should be a remaining income if they could have invested somewhere else, right? So this is what we call it residual income, right? So in this scenario here, now if you use residual income, now in this case, a manager, what he will do is he is encouraged to make new investment. If you don't make a new investment, still the charge is here, right? Even he don't make a new project, but still company will charge, and they will evaluate him based on what is the leftover income if you don't take any investment. So this is what we call it residual income. So this is another way to evaluate the performance of the manager, right? So residual income basically encourages managers to make profitable investment, right? That would be rejected by manager using ROI. If he is using ROI, right, before, he will reject. But if he use residual income, then he has to increase his income. How he can increase his income? By taking new investment projects, right? So if he increase this number, right, here, so how he will increase this number? By taking a new project, right? So as a result of this, his residual income will increase, because his benefit, his compensation or his salary depends on this number, not on ROI number. So this is just another way to solve an issue between in a responsibility accounting when ROI is not giving us a desired result. Or another way in responsibility accounting is to use a balanced scorecard. In balanced scorecard, this is, you might learn later on in some other courses, right? Here we use not only financial measures as well as some non-financial measures to measure the performance of a manager. What are the non-financial measures? Maybe customer satisfaction is one way, right? Or increase in market share, for example, right? Customer satisfaction, reducing customer return by certain percentage. These are all non-financial measures. So you can evaluate a performance of a manager not only with financial measures like ROI or residual income. You must attach some of the non-financial measures as well. Let's say reducing the customer returns, increasing market share, improving customer satisfaction, right? Or some of those could be many non-financial measures, right? Using some surveys to get a feedback on customer satisfaction. Employee satisfaction, for example, is also a non-financial measures, right? Employees turnover rate is a non-financial measures, right? How many employees are leaving the company, right? Because if more of the employees are leaving, it means employees are not satisfied. So one way to solve the problem of a responsibility accounting is to have a balanced scorecard approach where you use both financial and non-financial measures. And this is the end of this lecture. So if you have any problem, just send me an email and I'll explain you more. Thank you very much. Best of luck.